Okay, well, good afternoon and welcome again. This is Leilani Doyle. I'm the SVP of Product Management here at US Data Works. I want to welcome everyone to our fall webinar talking about integrated receivables and how it's more than straight-through processing. I see we still have a number of folks still joining, but we have a lot of content to get through, so I wanted to go ahead and get things started. Joining me today is Nancy Atkinson, who is a senior analyst at the IT Group. And Nancy, if you're there, if you might say hello.
Hello, everyone. Welcome to the webinar.
Great. Thank you, Nancy. Nancy, today we'll be covering a little bit about integrated receivables, trying to draw a definition of what this new solution is, why it's meaningful in the industry, and then also cover some of the findings that Nancy has uncovered as part of her research program. So you have a good understanding of the empirical data behind the need for this, as well as case studies of how we have actually implemented integrated receivables for banks and the business customers that they serve. So I think I'll go ahead and get started with a few opening remarks, and as people are joining, I hope that you'll follow along there. But one of the things that we get asked quite often, and I talk to a lot of banks and trying to provide education of this process, and I get asked a lot about why integrated receivables. Some of the smaller banks and my business customers aren't really asking for it. And the thing that I note is that if you think about what customers want and what they ask for, I think they don't always know what's the next new thing or what the vision might be. I mean, I look at this picture of a MacBook Air, love the Mac product, great product, but I know that in the late 70s, early 80s, the last thing that my mother wanted was a personal computer. She could not envision the need for a personal computer in the home or doing finance or writing recipes or connecting to friends through the internet. It was just not something she was asking for. And yet today, we can't imagine life disconnected without our MacBooks and MacBook Air, which I really like. And then came the cell phone. Cell phones itself, great invention, not necessarily something that people were asking for, especially one that didn't have any buttons on it. In fact, you think back to the BlackBerry days, they made a whole industry of putting lots of different buttons on the cell phone. And then Apple comes along, and Steve Jobs says, I want a phone that doesn't have any buttons. If they have one on them, they wanted to really go to none. It wasn't because people were demanding it. It was because seeing what it might be more than just a phone. It's a whole way of interacting with the world through the touchscreen technology. And then there's Uber. Love this example. I travel a lot for business, and ever since I started using it, my son told me about Uber, and I was a little bit skeptical because, traveling alone at night, not sure if I trusted it, but he had great experiences. And once I tried an Uber, it was just a better experience. Everything was prepaid. I didn't have to worry about getting a taxi when the taxi was going to be there. Would they take credit cards? All of that. It was a great experience. Uber driver shows up, water, bottled water in there, cell phone plug, clean car. And I think the same thing applies to integrated receivables, because when something is just better and it's transformative, it's just better. And as we see the way receivables solutions are evolving and the need that's come about primarily because a lot of these payments are going electronic, and as oddly as it seems, the more the payors and the payables automation systems push out electronic payments, the more complex it becomes to the receiver of those payments. So when something's just better, it's just better. And our view is that when integrated receivables is fully realizes its potential, it'll be something everybody uses because it's just better. And why US Data Works is interested in this and how we've garnered this experience. Well, we kind of created integrated receivables before it was cool. And people did it for some very large corporates, and as you go through some of the research that Nancy has uncovered, the problem was much bigger for the large corporates because they had a lot of different payments coming from multiple channels. And back 8-9 years ago when we first started doing the integrated receivables process, it was a much more painful experience of moving from paper to electronic. They were still very invested in paper processing, but the change was coming, and the change was coming quicker than anyone expected. So having that experience rooted in solid large corporate needs and wants has allowed us to take it to the next level in terms of making it more accessible, making it just a more seamless process. So I'm going to turn the presentation over to Nancy because I think she's going to reveal some of the statistics that show the driving force and why businesses are needing this. And then we'll come back to some more current relevant experience and do a little case study on how we've actually implemented it, not for a large corporate, but for a more mid-sized professional services business. So with that magic, if I do it right, I will turn it over to Nancy. And there's also the ability to ask questions. So as Nancy's going through her presentation, if you have a question, I'll be watching for questions. Please feel free to ask, and I will ask the question, Nancy, and we'll see if we can't get that interactivity going, because I know with the webinar you're on mute, and so it's hard to get that interactivity going. So Nancy, I think I've made you the presenter.
Can you see my screen then? Because I didn't see the opportunity to accept it. Let me see.
Here, let me try it another way.
Sorry.
We did this earlier.
We did, and it worked just fine, didn't it? Okay, here we go. Show my screen. Right. I'm good. Okay, and then I'll get this back up to here.
Yep.
And can you see my initial screen, Leilani?
Yes, the technology seems to be working, and I've got it.
All right, that's always a good start. So again, welcome everyone this afternoon. I'm very happy to be presenting with Leilani today and to talk about, how integrated receivables really can be more than straight-through processing, and what can that mean for your company, your bank, if you're a provider or you're looking at providing this service, and so on. So basically, I'm going to talk about some of the trends that we've seen in generally in disbursements and collections. Disbursements is another word for accounts payable, as I'm sure you know, and collections is another word for accounts receivable. So I'm focused on both sides of the company's payments components. And then we'll talk a bit about some of the challenges and the implications of those challenges that the payer and receiver experience with these payments that are B2B payments, business to business. We'll talk about what an integrated receivable solution should include, what sorts of components should be there, the benefits that can be gotten from being involved with integrated receivables and using it, and I'll make some recommendations. So we'll start out now with some of the trends. And this slide, I wanted to talk about the fairly broad implications of payments on the financial components of companies. Traditionally, day sales outstanding is the key metric for receivables processing and the accounts receivables area, and their overall goal is to reduce the day sales outstanding, whereas days payables outstanding is the key metric for the accounts payables area. And in that case, the goal is to extend those days, make it longer and bigger. But what that then does is potentially impact the suppliers that your company might utilize on an ongoing basis if you're really making payables payments later than you otherwise could. So then we introduce as well there are going to be maturing short-term investments, maybe not too many in today's nearly 0% interest rate environment, but all of those items then contribute to what the cash flow and the liquidity management looks like at the company. and leads to working capital management, and optimizing that is the overall goal. Now, there are a few other areas, as you can see here. Inventory, the sales forecast, procurement all play into optimizing working capital management, which is generally handled and managed by Treasury today. And the importance is that when you're making decisions about when to initiate a payment, what instrument to use, what channel to use, all of those decisions actually do ultimately impact the working capital management, which frequently impacts your company's stock prices if you're a public company. So it's an important component of everything in businesses, and they are looking to streamline those processes to the extent that they're able to. The channels shown here really only represent those that are used to initiate payments. The internet channel is, of course, online, but what's interesting is that there are also receiving channels, of course. And the number of receiving channels is pretty comparable to this list. In fact, we've counted 12. And in particular, the online channel for the receipt of data is a challenge for receiving companies because there are so many trading partner networks. Those are also known as business commerce portals. And frequently for receiving companies, they get messages from the payers telling them, okay, go to this online link and look at the details behind this payment. And then another payer sends in a different link. And so they really are facing a multiplicity of these channels, and that makes life very difficult for them. The payments type list doesn't today include Bitcoin and other cryptocurrencies, but probably it should, and I will apologize that I didn't add them in this regard, but they're not extensively used yet in business-to-business exchanges or B2B. We're sure, however, that there will be other types of payments that are going to be utilized and that will come along. And, who knows exactly what that will be. Maybe it'll be a biometric. I don't know for sure. Regulatory issues, we all kind of moan when we hear that term, but it's a reality. And in this case, I want to focus on the top one on this list, which is the Know Your Customer, because one of the things that is becoming a real challenge for the banking industry, but also for companies looking at your supplier base and identifying potential suppliers that you want to utilize, and for the suppliers to know their customers and make a decision on whether or not to extend credit to those customers so that the customer can pay on what's called an open account, meaning that once they receive goods or services, then the payer owes the money, not before that. Obviously, that puts the supplier in a position of extending credit to that buyer. And the requirements are continuing to become more and more stringent. And furthermore, banks in particular are looking to extend their support beyond their direct client to potentially a client's customer, or a client supplier rather, in some cases, so that if it's a very key strategic supplier that the client wants to be sure is financially sound or can continue to produce the goods or services that they need, then they may want their bank to help support that particular supplier based on knowing that a payment's going to be made by the client of the bank. But how does the bank really know that the client supplier who that client supplier is when they have no direct relationship with them? So that's a definite challenge that they're beginning to face. And then last on here, but certainly not least, is that data about the payment and with regard to the payment. And by that I mean information such as the timing of the payment. When was it initiated? When was it received? By whatever incoming channel it's coming through. When will it clear and settle? What channel was utilized? What payment instrument was chosen? Was there any kind of a conversion from a check to an ACH or an ACH to a wire going through that process? Were there any problems or delays? All of that information is at least as important as actually receiving the funds. And each of these areas really that it shows here relies on data to improve their performance. So it's all very important, and it all does come together, again, under Treasury. And the good news is that Treasury does have a fairly broad vision these days across the entire company. And so Treasury can make some decisions regarding those days sales outstanding and the days payables outstanding that I commented on before. We're finding, for instance, that again, given our low interest rate environment right now, there's not a lot of opportunity for companies to invest excess cash. But if they can get a payment approved on an invoice for a supplier and make that payment earlier than they normally would, if they can get a discount from that supplier for making that payment early, it may be better than extending days payables outstanding. And so that's a concept that is really becoming important when you look at the overall experience between trading partners as buyers and sellers, and with regard to where the business is going to go. I've seen these numbers that I'm showing you right now taken out of context and misquoted recently. So let me be clear. What the left chart says is that 70% of US-based companies make more than half of their B2B payments by paper check or draft. Because this is so important, I'm going to repeat that. 70% of US-based companies make more than half of their B2B payments by paper check or draft. And this is a mixture of sizes of companies. It's from very small businesses to very large businesses. It does coincide fairly well with the AFP finding that roughly 50% of B2B payments are made by check. What you would see here is that we do have this mixture of the smaller businesses that are more inclined to make payments by check, and some mid-sized, some large businesses more inclined to make electronic payments. But that is an important concept, and so checks are still very much out there, but you do notice that there are other types of payments out here as well. Similarly, the right chart is saying that 59% or almost 60% of US-based companies receive more than half of their B2B payments by paper check or draft. Now, that finding is a bit surprising to me because so much of the Check 21 movement from having checks actually clear and settle as paper and instead be moved to imaging, I would have actually expected it to be an even smaller number, but this is what was reported to us. So, but what we also see then is that discrepancy between, okay, 70% of payments were initiated by, or 70% of companies' payments, or more than half of them, are initiated by paper check. I'm going and blowing this statistic now, sorry. But only 59% of companies have more than half of their payments coming in as paper check. Well, that goes to the converting the paper checks for image clearing and settlement. But we are seeing, as you can see here, that while it's not huge components of overall payments, credit transfers, also known as ACH, wire transfers, cards, direct debits, also known as ACH, are also being utilized by companies for B2B payments. So, we are seeing some electronic movement as we go along. So let's talk a bit about what some of those challenges and implications are. Leilani mentioned at the beginning how electronic payments do bring their own set of challenges, and while there's definite movement towards it, and electronic payments, I think we all realize and accept, will create efficiencies for both trading partners, the buyer and the seller, when they're able to automate processes that support the electronic payments. Some of the challenges that I have listed here reflect technological shortcomings. Some are based on processing issues that one or more of the companies might have, and some are behavioral changes that are required in order to really process electronic payments and get the full benefit from them. And quite honestly, from my experience, behavioral changes are usually the hardest to address. So, the first one here, that the payment recipient doesn't want to share their bank account information with their payers. It's rather ironic to me that bank account information has really been available to the payer forever. It's printed on paper checks.
Along with the signature. I mean,
yes, exactly,
Leilani. And you make an image of it, and you store it for a long time.
Exactly. Yes, but having it stored in a database as a trading partner and letting that partner use it to make payments has really been a hard leap for many suppliers to overcome. So, that's one that's out there, but it's a behavioral change that's necessary. Further, another issue is that, companies do change banks. They don't tend to do it terribly frequently. It's not like I'm going to have one bank this month and another next and a third the next. But they do make changes based on business decisions, or they may open new accounts for their payables and close other accounts. They might decide to rearrange the purpose of certain accounts and so on. So that makes it difficult for the payer to really maintain that information on the banking information. Now, the Electronic Payments Network, or EPN, which is part of the clearinghouse, did develop a system. It's called UPIC, or Universal Payment Identification Codes, to solve this problem. They maintain a database where they update changes to the bank and account information and associate those changes to the proper UPIC. So trading partners only have to use the UPIC, and the underlying data should be accurate, so long as the receiving company has updated it, of course. The problem is that only EPN supports the UPIC, and if banks use the Federal Reserve as their ACH processor instead of EPN, then the capability doesn't exist for that group. Additionally, not all companies have signed on to have a UPIC, and so on. So there's a possible solution out there, but it hasn't been fully embraced. Frequently, remittance data comes in through a different channel from the payment, which then creates this need to reassociate the data and the payment. And often more than one voice is paid through one payment, which I think you all are aware of. So that leads to challenges with being able to identify it. And there is no common standard format for providing or receiving remittance information. In fact, standards aren't really standard from my experience. How many versions of EDI, the X12 based, are there? I have no idea. Thank you. Yeah,
it depends on however you interpret it. It's quite different, having looked through a lot of that stuff. Yep.
There you go. And unfortunately, as well, we tend in this industry, once we have something out there and someone's embraced it, everyone's very hesitant to shut it down and say, no, you have to move to this next level as well. And then internationally, UN EDIFACT is used instead of X12. So if you're a company that receives international payments, they're not going to use an EDI type of format that's X12. And then we see, this whole thing at companies where in many cases there's no integration between their payments and accounting systems, or at least very limited. I would say that the payables, the accounts payable system, which may be part of their ERP or might be a standalone, does integrate to the creation of the payment. But once you get that, it's no guarantee that there's going to be further integration as you go along. So those are the challenges. Now, some of the issues as well become, okay, who decides what payment instrument to use and what channel to use? And for this particular survey that I'm showing here, we expected differences depending on the sizes of companies that were making up trading partner pairs. For instance, we thought that combinations of large corporate buyers and sellers would follow their trading partner agreement. They'd have one, they'd follow it. We thought that large corporate sellers would dictate to small buyers how to make the payment. Boy, were we wrong. It is almost universal that the payer decides what payment instrument and what channel to use. Receiving companies want the money, and they'll take it any way they can get it. So that was an important finding to really understand. another question that we asked then, since the payer is going to make the decision, what were the 3 most preferred methods for sending the remittance information by the payers? And what you can see here is that the top 3 methods by which the payers prefer to send remittance information are mail, email, and fax. Isn't that exciting?
That lends to a lot of automation there, right?
Yes, absolutely. Now,
on the part of the receiver of the payment, so it's much difficult.
Exactly. And that makes for definite challenges when you look at it that way. So you'll see that there are some statistical differences by company size regarding the preferred methods, but overall, the 3 methods I mentioned, mail, email, and fax, are most preferred. You see this finding as being counterintuitive to you? Would you have expected that?
Not after spending all those countless hours in meetings working on EDI standards, I wouldn't.
Exactly. So
this one.
Yeah. Well, let me show you why payers prefer these methods then. What you see here, we divided it into just mail and email. Sorry, I didn't show you why they prefer faxes, because it was the third of them. But overall, the payers say their preference for mail, which is the left-hand chart, is habit or standard practice. So it's what we've always done. It's the kind of, why do you like mail? Because that's how we do it, kind of an answer. Other reasons mentioned were that data comes with the payment, which is true. If you have a check and list, you get the check, you get the list of all the data that comes with it. They have a paper trail for audit purposes, and they see using the mail as easy and efficient. Now, we might question that, thinking that if it became an electronic process and it just got mailed out, it'd be fine. But when you really think about it, in many cases, payable systems are geared to send a file to a check printer that is also going to print the other information. It can fold up the paper, stick it in an envelope. It's already an addressed envelope, and off it goes. So it is a fairly automated process for them. The payer's preference for email is based on their perception that it's quick and timely, easy and efficient. And I mean, everyone has email these days. So for one thing, it's perceived as there being no additional cost to use email to do that. And the level of detail and record of the information received is high. The fact that it has to be rekeyed isn't really a consideration for the payer because they're sending it out.
What's interesting to me, Nancy, is that we see the use of email even with those payors that are using payables automation networks or the portals that you're referring to. Even though they will send out a notice saying we've paid you, you can log in here to get it, but they'll many times send a attachment, a PDF attachment or whatnot that has the same information that's available on the portal. So even that is kind of something we would not have guessed being used as widely.
That's a very good point, Leilani. It's certainly the reality of what we have seen. Now, it was interesting to me to hear from some large corporations, and this may be part of why they do what you just said. They've automated the feed from their payables to an email to send that detail. So from the payer side, again, it's automated, so it's fine. The receiver, however, has more problems with it.
Yes.
So, we asked the receivers the same question with regard to their preference for receiving remittance data, even though they have no say in it, other than one rather unique approach, which I will talk about. But in the case of receivables respondents, it was pretty overwhelming, though, that they prefer email to receive remittance details as well, regardless of the size of the company. Does that surprise you?
I guess it's easy and everyone has it. So
Yeah, I think, it is that. It's also the completeness of the information. So, and all sizes of companies have the same top 3 reasons for preferring emails. You can see here we divided this into the large corporations, mid-sized companies, and small businesses. And just so that you can put it in context, small businesses were defined as companies with less than 10 million in revenue. Mid-sized companies were those with more than 10 million to 500 million, and large corporations were anything above 500 million. And every single one of them basically said, it's easy and convenient, it's quick and timely, and we get the complete information exchange for the levels of details. The only thing that really kind of changes here is the percentages that go in one direction or another. So for the small business, the level of details and record of information exchange was number 1, whereas for mid-sized companies, easy, convenient, and quick and timely tied for number 1. And for large corporations, easy and convenient came in as number 1, but I would tell you that the level of details and record of information is statistically not a significant difference there. So that's what we saw happen. Now, I promised that I'd mention, though, the one way, Lockbox. Lockbox is the way for a receiving company to redirect payments from wherever it was going to be mailed to a location where where the receiving company has chosen to have it sent and deal with the payments in Lockbox. So that's one of the advantages of Lockbox. Having said that, though, 67% of large corporations use Lockboxes today. Only 18% of mid-sized companies do so, and only 10% of small businesses use Lockboxes. I would say that out of the total picture, it looks to me like there's opportunity for mid-sized businesses to really improve their processing by considering a Lockbox solution. And I'm not a Lockbox salesperson. I get no return on this one, but it is one of those.
So Nancy, a couple of questions. One is,
Sure.
I thought it was a really good point about how the Lockbox is one example of how the receiver of the payment is able to kind of take back control of how the payments come in. Do you see that having a more robust or some kind of integrated receivable solution that may be offered by a bank or offered by some other third-party service could in fact help solve some of this complexity that's creeping up, and would that be a reasonable opportunity there?
Absolutely. That's certainly something that we expected, and in fact, not too much further along here, I will be sharing some data from a study that I did of receivables banks and mostly Lockbox managers, but part of what drove that was being asked by the press if Lockbox was going to disappear. And you can argue that Lockbox has a lot of the capabilities that are needed to actually build an integrated receivable solution. So it's something where some banks are looking at Lockbox, others other ways.
We kind of did the reverse. We had integrated receivables and built out more Lockbox or paper capabilities. So it was kind of an interesting dynamic. I have a couple other questions from the audience, and one was pointing out that the survey data is from 2012, and was curious if there were any insights about how much the preferred methods have changed over the last 3 years.
Yeah, you are correct. The survey data was in 2012. I will tell you that the world changes like a dinosaur moving across a desert when it comes to business to business. I have done some slightly more updated surveys of mid-sized companies, not necessarily. This particular grouping that I'm showing here is, again, a mixture from small business to large corporations. And I have not seen a significant switch in any of this type of data. I would say that it's still pretty much accurate. I realize this is 3 years later, but things do move very, very slowly.
The only thing I've seen in looking at other studies is that the percent of electronic payments have continued to expand, and I've seen it moving past 50% or at 50% for B2B payments, even in the mid-tier market. Okay. So that's the only thing I've noted, but we've not done anything in depth like this. So.
Well, I think that's a good point, though. I mean, I think it's going to depend, so much of this, to be honest about it, again, our surveys were based on certain industries, but I don't have a significant number of any one industry to be able to really pull it out and say something about it. But I'm sure that there are certain industries that have been more effective in moving electronic payments. Just as, let's go back to EDI, the automotive industry certainly was a big adopter of EDI in this country when we had the big three. And basically, if a small supplier wanted to work with them, they had to implement EDI. No matter how expensive, no matter how confusing, no matter how difficult, it was a requirement. So there are certainly going to be some industries that don't fall into this category as well.
Okay, good.
Any other?
There was one other, and I think I'll cover it when we get to kind of the case study example.
Okay. Sounds good then. So, we asked, now this study is even older. It's from April 2010, February to April of 2010, but it was of 81, I believe, 80 U.S.-based businesses with $1 billion or more in revenue. So these are the larger corporations. And, what we did, was say to them that, what are your challenges with receivables processing? What factors negatively impact your receivables processing? The list that is here is not the complete list that was suggested to them, but there are challenges that at least half of senior receivables and treasury managers at these companies identified as receivables processing challenges. Notice that they reflect many of the factors that we described with regard to the complexity of payments collection. So you're looking at large or growing numbers of exceptions and returns, incomplete, inaccurate data, large number of channels through which payments are received, inconsistent payments handling due to multiple payments types. So it's, it is something, and this was large businesses. If large corporations who tend to have far more systemic solutions in place are struggling with these kinds of issues, I would expect that mid-sized and small businesses have at least as much of a headache with regard to that.
Yes.
So then moving on, let's look at mid-sized companies then. These charts represent IT group data that we collected through poll questions during a webinar. That's the left-hand chart. And a study that was conducted by the Federal Reserve Bank of Minneapolis, which is the right-hand chart for the Remittance Coalition. From IT Group's data, we see that for nearly 2/5 or 40% of respondents, timing of payments caused the greatest pain. Now, the big difference is that the IT Group data asked, what's your one top challenge? The Fed study asked for your top 3 remittance data processing pain points. So the IT list should add up very close to 100%. There may be some rounding errors, whereas the Federal Reserve one is going to come up at much more than 100% because they allowed for 3 answers. But you still see that timing of payments causes the greatest pain, or caused the greatest pain, to mid-sized companies. And about half as many of the respondents, or about 20%, cited matching and reconciling payments to invoices as being their most significant pain point. The Fed study asked, again, for the top 3, and nearly 70% of respondents said that their back office systems don't support automated matching of invoice and payments data. The next 2 most often cited pain points, with about 40% of respondents, both have to do with the remittance data. It's either missing or it comes in different formats that they can't process. So mid-sized companies are still being challenged by those types of issues. Further, this slide is also one of the Federal Reserve slides. You will see that almost 90% of respondents said that the information they received via email, fax, or mail, which we remember are the payer's preferred methods of providing that information, has to be rekeyed. And also remember that it's highly likely that the rough 1/3 of respondents that say they get the information through a portal or network must go to more than one to collect all of the data. This shows, though, that, and it's a reasonably positive sign, that nearly 1/3 of respondents can process this data straight through. But I want to put in a caution here as well that the respondents to this survey for the Fed skew toward large corporations. They were mostly members of the Association for Financial Professionals, or AFP. And basically what the Fed did was rely on organizations like AFP. They did go to a small business group and to a credit management group that could pick up some more mid-sized companies to distribute the survey. But out of that 662 companies, I believe close to 400 were from the AFP. So that would tend to skew towards the large corporations. So now let's look at middle market companies. And it's a much smaller sample, as you can see. It's about 1/10 of the size of the Fed survey. But nonetheless, the middle market companies' receivables experts actually reached a fairly similar conclusion. Almost 1/3, or 28% of these companies, say that all of their remittance data is captured by scanning equipment, which sets up the possibility of straight-through processing. And that's, I apologize for the kind of negative approach here, but the percentages that are going down the left-hand side are the percentage of data that is not captured by scanning equipment. So when you see a 0% not captured, that means all of it has been captured for 28% of the respondents.
Interestingly enough, what we've seen, Nancy, in trying to automate this for middle market companies is even if they were getting an email, they were typically printing the email out and then imaging it into their system. Yeah, as support documents, or imaging it into a couple of different systems. In some cases, it was being scanned 2 or 3 times based on if it needed to be routed to somebody for approval. We just found that to be hugely inefficient, and that why scan it if it starts as electronic to begin with?
Right. You would prefer not to have that happen. Yeah. As you can see in this slide too, I mean, I've still boxed out that 40% of companies really indicate that from 1/5 to all of their remittance data cannot be captured by scanning equipment. So, and some of those numbers, because the question exactly as it was asked is shown up here. It's possible that someone perceived our question to be, okay, well, we get an email, we print it, we scan it, so we captured that by scanning equipment.
Right.
So it could, you know, so we don't know for sure on that part. But I think it's clear that there's still room for improvement in terms of all of this.
I know we're getting it, we're about 142, so I'm not sure how many more slides. I know that we want to save some time for question and answers.
Okay, yeah, I'll pick up the speed a bit then. As this slide just is to show that middle market companies told us that they have a wide range of staff that are assigned to resolving discrepancies between the invoice and the amount that they actually get paid. Overall, the average is 8 full-time equivalents. But we are seeing, let's see, the most frequently reported number is actually 2 FTEs. That was from 23% of respondents. But as you get into that larger revenue group, the 250 million to 500 million in annual revenue, you're seeing that, you know, at least one company reported 40 FTEs. So, you know, streamlining the processes can certainly speed the posting of payments and closing of invoices, which will help reduce days sales outstanding and loosen available credit for purchasers. The most important part about this is to notice the fairly low straight-through processing percentages. They're shown in dark blue to the far left of each bar. And if you ignore the anomaly, which is cash, none of the other payments instruments have straight-through processing rates that exceed 15%. So we're still a long way from true straight-through processing. Moving on then to actually start to define what on earth an integrated receivables are. We asked on this list all of these to determine whether or not they were considered important, and actually all of the functions that are shown on this list, which is quite a list, were deemed at least important to large corporations, senior receivables, and treasury managers that were thinking about an integrated receivable solution. I just want to point out a few that received the highest percentages of essential would not implement without this feature. And the first one is the automated exceptions processing, including workflow. The automated invoice matching is another one. Clearing and settling all payments types to your company's bank accounts is another one, and another high one was automated posting to internal accounting, credit, and treasury systems. So going from there, this information was taken from a survey of North American bank lockbox providers in last year, April to August. Many of them, well, about a third have already developed an integrated receivable solution. Another 40% want to develop it, and the rest haven't really made a decision one way or another. But fundamentally, integrated receivables has to support all payment instruments and their corresponding remittance details. So that's the table stakes. When you look at then some reporting options, given the payer preference for mail, email, and fax delivery, it's important for banks and third-party providers to support those channels. And frankly, from the numbers, email is not supported by very many banks, and I think that's something that they should seriously consider, especially given the preference from the receivable side. BAI2 is generally supported by providers of integrated solutions, but we're not seeing a lot of uptake on the new BTRS. Banks are saying, no, we're not doing anything with it, and no, our customers aren't asking for it. And EDI is in particular provided by the players who have large corporation clients and have a need from it. Online reporting is done through a combination, if it's coming from a bank, of that email with the link that Leilani had talked about before to the online details. And in many instances, if it's coming from a bank or another third-party provider, it's just one of many that the receivables client has to go to get that complete picture. And then finally, probably the ultimate solution is a single integrated receivables posting file that automatically interfaces with the receiving company's receivable ERP and credit management systems. Then we move on to the idea for integrated receivables is that there's going to be some real value adds, and banks and third-party providers that want to offer it or have offered it are really driven by two major goals: to retain important clients by offering enhanced services, and to increase revenue by being able to charge for the benefits from those enhanced services. So the enhanced services, you might say that electronic invoicing or billing is not really an enhanced service, but it's not one that many banks or third-party providers are offering in this space. It is growing in adoption in the U.S. On the consumer side, we know that getting bills directly from the biller site has pretty much won the solution, but for business and government, there's still some shifting going on. And the importance, really, of supporting invoicing is to have the match against received payments and reported payment details. Then we look at some of the newer services, so that accounts receivable matching is supported and helped if you get electronic invoices or billing. And the automated rules, one of the approaches going beyond the matching is for the receiving company to provide automated rules that they want to be applied to incoming payments. So as an example, it might be that if a payment is under $100,000 and is within plus or minus 5% of the invoiced amount, accept it, consider it closed, and move on. Or it might even be specific to a particular payer and the relationship there in terms of what rules get established. And then the final capability that we're showing is provision of an online portal where the buyer and the seller can actually negotiate on exceptions. We don't see that being offered very much by banks. And frankly, we feel it's better for banks and third-party processors to partner with trading partner networks. Some examples are like Ariba and Tungsten, TradeShift, some others that are out there. And you can rely on the network partner to provide that negotiation service because it's so important to have that base of both payers and receivers. So quickly through some of the benefits then. Let's just start with the middle boxes. The top one is just to say that this is what the whole thing is. The first on the left is accelerating the application of cash and information, which fundamentally will reduce day sales outstanding and speed up credit availability. Because if you've already closed out the invoice, then the buyer has that money to be able to go buy more. And makes analytical inferences about payments is really assisting with trading partner agreement negotiations and allowing for fact-based decision-making. And the bottom row goes into a little more detail on that, but given our time constraint, I'm going to move on. Integrated or consolidated receivable solutions should provide benefits for clients of providers and for financial institutions that offer them. And basically, I'm going to scroll through these benefits, give you a chance to see the benefits that we've defined, but I'm not going to read them to you, and copies of the slides will be provided afterwards. So there are a number of benefits, though, that can come through from this type of solution. And we do believe strongly that those are of value to both companies and to the financial institution. And why don't we just move to any questions that you might have at this point, Leilani? Or give you a chance to, or do you want me to give you back the presenter so you can show the case? Sure.
Yes, I do have a case study I thought might be interesting, and it will answer one of the questions that's still outstanding. So maybe if you click the change presenter.
I just did, so hopefully.
Good. Okay. So thank you all for staying with us. I know we're running a few minutes over, and I really appreciate your time and attention there. Thank you, Nancy, for sharing some of the insights and empirical data there. We see it more anecdotally in working with a lot of banks who are actively have integrated receivables evaluations going on this year or 2016. When we see it as truthfully a way that we connect billers and payors and their banking data together to provide a simple interface for solving the email problems, doing the AR matching, getting great automated posting rates, and helping with exceptions workflow. No matter how a payment comes in, you've got a cash application process that needs to be run according to the biller's cash application rules. And it doesn't matter if it comes in by ACH credit or wire or mail or through a lockbox or remote site. It still is the same process there. The same data needs to be passed to their accounting system or needs to be passed through an approval process. So we really see it as being that glue holding it together. And when it's fully matured, it will just be the better way of doing cash application process. It will be the natural evolution that we see taking place on the payables side there. So in terms of a case study, how we've actually seen this roll out, and although we've done some large corporates, remember Big Pain, this one was a pretty interesting case in that it was a professional services company. They were actually located in the middle part of the country. We were actually providing lockbox services for this bank, and the lockbox the bank had selected our lockbox because we had this vision of integrated receivables. And they had a business that was looking to do something on the integrated receivables side, primarily because they had a lot of government contracts. They were providing professional services using historically underutilized businesses or minority ownership, so they were a subcontractor to a lot of large government contracts, and they were getting paid 75% by incoming ACH credits. But even though most of the agencies were federal in nature, the way the payment came in was inconsistent. Sometimes we'd have a simple, one addenda record, would have no addenda record. The dollar amounts were different than the actual invoices when we were doing an analysis of that. So it was a difficult process to match that up. But yet they were getting most of the notices through through emails. So they were getting how to apply it from what agency for what invoice or set of invoices there, and if there was any other kinds of business information, like they needed to make a change to a purchase order or other kinds of contracting numbers that were relevant to this business. So they were getting all this documentation by email that had to be connected to the cash application process. So in case they were audited, they had all of that connected in. So this is one of the cases where they were printing and scanning in emails. And then, of course, we observed adjustments to invoices. There were disputes on hours being reported incorrectly, billed at incorrect rates, travel per diems being needed to be adjusted or billed incorrectly, and there were other reclassifications to departmental codes within the federal agency. So there's a lot of back and forth to this professional services company, but because they were primarily providing technical resources, they thought there's got to be a way to solve this. So we were grateful to work with them to take our solution and make it suitable for this kind of processing as delivered as a bank service. So not trying to sound like a commercial here, but did want to talk about some of the implementation steps that we went through. One of the things that we found is key, although we weren't doing electronic invoice presentment, we did start by assuming that if we could get a list of the outstanding receivables out there as part of a regular process, much like sending in checks when you do positive pay, that we could do a better job of matching up incoming ACH payments to outstanding invoices and solve some of the headache they were having in trying to match amounts. We could look at sender information, match that back to a customer, and do the processing. In addition, instead of printing the emails, just route the email into our integrated receivables solution by setting up a specialized email address and forwarding that email information there, where we can do further filtering on it. We actually parse through the emails, read it, identify keywords, dollar amounts, dates, all of that important stuff, and use it to help glue this information together. We had to work with the bank, although we were doing their lockbox processing, so we could use it for handling some of the lockbox exceptions for the 20% or so that were coming in by mail. We had to work with them to get their ACH and wire details out of the system. This particular bank did not have a centralized reporting system, so we had to kind of jump through some hoops to get those files routed so we could read through that and do the matching. So that was a process. And then we determined the cash application rules. There are several different cash application rules. Do you apply it just to an account? Do you apply it to an account and an invoice? Or do you apply it to an account and an invoice and a line item? So getting all of that configured and set up was kind of the next natural step in the process. And then a key differentiator, what we think really will take this to the next level, is the older systems, integrated receivables for large corporates, depended a lot on a lot of advanced setup and configuration. But we found that for the middle market companies, if we could teach the system to learn based on human behavior, so that the first few times you run through this process, the system observes how the human is matching payments to invoices or payments to emails to get the information about how to apply. And then we can apply those rules to do auto parsing, auto correction on account numbers or invoice numbers, and auto filling in amounts so that you're not having to rekey an entire line item invoice. We can auto fill that in for approval. And then since we know the cash application rules, we can route things to various exception and approval processes, which is probably the last piece that we had implemented in there. So what? It seems like a bit to undertake, but once we had it in, and we were fortunate that it was more of a technology company, they were able to reduce their staff from 4 FTEs, which oddly enough kind of coincided with what Nancy had reported for a company of similar size, down to 1 FTE, because we were getting about a 78% straight-through processing rate after 3 months of applying these learning techniques and auto-parsing techniques. So the straight-through processing meant that we were able to match the invoice and fill at least partial information from that invoice in for getting a clean posting file out. But what's more interesting than the straight-through processing rate was, for this client in particular, was the simplified audit controls and approval processes because they were a government contracting business. And I guess this applies to most businesses. When you do cash application, you're writing off exceptions, or you're noting errors on the invoices, or you're agreeing to take a payment. There's a lot of back and forth on the emails that go on. There's notations on email attachments, and having a centralized repository that can be researched based on the payment was a pretty big plus, and the fact that it was part of this overall processing made it even better. And then as a result of this automation, we were able to get feedback loop to contracting agencies. So there was information that this professional services company could provide to their contracting agencies to try and get better straight-through processing rates, correcting their customer account number, correcting POs, and that kind of thing. So that's just an example of how we have done through a case study there, and I will open up the floor for any questions. I know that we had a question that came in was, given the fact that email is a preferred method of remittance detail delivery, does US DataWorks have a solution to capture this information systematically? And yes, we do. We have an internally developed system that reads it. It uses some intelligent learning techniques that we've implemented to parse through keywords and look for dollar amounts, and then combine that with actual human behavior to get a good reading through. And then I have another question. Are you seeing any requests from clients for customer-initiated entry or the ability to make corrections in the data relative to an incoming payment? And yes, I know we talked about this business case, this use case being in a B2B scenario, but we do have clients that are in more of the retail space or small business space, small business and consumer accounts, and they do use this technique for doing the auto correction. So the problem is the customer or the customer who goes into their online banking portal or a consolidator, they enter their account number wrong, and it's wrong in there forever, right? They never get it right, or they've entered a partial port. Once we get that solution in, we detect that that account number is wrong. We see that it's been corrected, that a correction was marked as being accurate because we've reviewed the posting that went to the AR system, and we'll make that correction in the future so that as you get bad information on these consolidator files that come in, either consolidator files or paper information that comes in a lockbox, we'll continue to make that correction on an ongoing basis. There. Okay. Well, I know we've probably exceeded our time. I appreciate everyone for staying on the call. I will make a copy of my presentation and Nancy's presentation available to you as PDFs, and I will distribute that out to everyone that registered to the webinar. Look forward to future webinars. We'll have one likely coming up again, December, January timeframe, and hopefully you will plan to join us. Nancy, thank you so much for your information.
Thank you, Leilani.
And we'll see you at AFP.